Peace and love, good people. Peace and love. So let's get right into the Commodity Channel Index, or CCI. I wasn't all the way clear on what that is, so I imagine if I don't know what it is, then maybe some of you don't know what it is. So who am I to learn about this without sharing it with you all? Because explaining it helps me with retaining it. So let's go through it. The Commodity Channel Index, CCI. Please subscribe to the channel. Like this video. We need 1,000 subscribers. I need 1,000 likes on this video. All right. And comment. Let me know I'm not talking to myself. All right. So are you familiar with the Commodity Channel Index? Let me know below. And click the link in a bio to join the Patreon. Join the Patreon. On my Patreon, I share some of my plays for the week. I try to bring some of them to YouTube, but I think that it's better to share those with my unwavering supporters in the Patreon. So click the link in the bio to join the Stock Market Daddy Patreon, where I will share some of the plays for the upcoming week based on my technical analysis, not giving out financial advice, but just giving you more access to the decisions that I'm making based on the many things that I am sharing with you here on YouTube for free. All right. So implications. Trading Central identifies the following CCI events, the Commodity Channel Index events. A bullish event when the CCI rises above the plus 100% line. Another event signaling the end of the previous bullish trend occurs when the CCI subsequently falls below the plus 100% line. A bearish event when the CCI falls below the negative 100% line. Another event signaling the end of the previous bearish trend occurs when the CCI subsequently rises above the negative 100% line. All right, interesting. All right, so they told you when to recognize, 2 ways to recognize a bullish event and 2 ways to recognize a bearish event using the CCI. It's all based on this 100% line and whether or not the CCI rises above or below that. Now, description. Although the name CCI uses the term commodity, the oscillator is commonly used for analyzing equities. A CCI is based on a comparison of price and moving average. I hope you're noticing the trend that no matter how fancy we get, what name we give it, we're coming back to the average price. The average price. All right, so a CCI is based on a comparison of price and moving average. The CCI is expressed as a percentage that oscillates between negative 100 and 100. However, these levels can be exceeded. The Commodity Channel Index quantifies the relationship between the asset's price, a 20-bar moving average of the asset's price, and the mean of the absolute deviations from that average. It is computed with the following formula. CCI equals the price minus the moving average divided by 0.015 times the absolute deviation. All right, don't let that go over your head. They give us formulas to let you know the method behind the madness. But if you can use once you use the indicator, normally the indicator is calculating the price for you. But they give you the formula so that you can verify and confirm that the equation or the CCI data that they're giving you is actually being computed properly. Typically, if the price is greater than the moving average, then the CCI will rise towards or above the 100% line. All right, so if the price is greater than the moving average, some of us will consider that overbought. All right, when the price is above the average, it's overbought. All right, it's in high demand. If the price drops below the moving average, then the CCI will drop towards or past the negative 100 line. This is meaning that it's oversold and the supply is high. Don't let that go over your head. There are divergences and exceptions to the price divided by CCI behavior that technical analysts should be aware of when making trades. All right, so trading considerations. That last line is just saying that nothing is perfect and nothing is 100%. All right, so be mindful where that, 10, 15, 20% of inconsistencies may appear. Trading considerations. Technical analysts use CCI in a couple ways. 1, to predict a price reversal. How to predict a price reversal? You may want to consider using the CCI. And 2, to determine overbought or oversold conditions. Well, I just said that. To predict a price reversal, compare the direction trend lines for the price and CCI. If the direction of the price trend line is different from the direction of the CCI trend line, a divergence is said to have occurred and a price reversal may follow. All right, so divergence may lead to reversal. The most popular way to use the CCI is to watch for overbought or oversold conditions. A stock is considered overbought when it reaches 100% or higher, and oversold when it is negative 100% or lower. Some technical analysts use CCI with the view that an overbought condition precedes a price drop, and that an oversold condition precedes a rise in price. Colby, however, identifies the trading rules for using CCI as follows. Buy long when CCI rises above 100%. Sell long when CCI falls below 100%. Sell short when CCI falls below negative 100%. Cover short when CCI rises above negative 100%. All right, so buy long. Buying long means that you are buying stock to own with the expectation that prices will rise. You expect to earn a profit when you sell the stock at a higher price. Selling long means selling a stock that you own, ideally at a higher price than when you bought it, so that you will earn a profit. Selling short means that you are selling a stock that you have borrowed with the expectation that price will fall. If the price falls, you can profit by buying back the stock at a lower price and using it to replace the higher price stock that you borrowed. This is like selling a put. For example, if you sell stock for $100 per share, buy it back later at $70 per share, and then return the stock to the lender, your profit is $30 per share. Covering short means that you are buying stock to replace stocks that you have borrowed. To maximize your profit, you will want to buy back the stock at a price that is lower than it was when you sold it. All right, so that is the Commodity Channel Index explained. So now anytime you hear people talking about CCI, you'll know that we're using the data to help us determine, all right, 1, if there's a price reversal, and 2, if there are overbought or oversold conditions. All right, peace and love. Subscribe to the channel. I hope you get rich, and I'll see you in the next video. Peace.